Hello students, welcome to EPG Pathshala. I'm Navina from HPU. Today we are going to talk about on module accounting ratio, meaning, significance and limitation from paper accounting and finance. Learning objectives. This module will focus on how to interpret financial statements with the use of various ratios and interpretation of ratios is an important factor. Ratio analysis is one of the principal tools of financial analysis. Ratio analysis helps in assessing how various each items in a firm's financial statements relate to each other. Introduction. Ratio analysis are the process of establishing and interpreting various ratios, that is quantitative relationship between figures and groups of figures. Financial ratios are determined by dividing one number by another and are usually expressed as a percentage. ROE, that is return on equity, is the starting point for ratio analysis. The three drives of return on equity, which are as following. First, net profit margin, the rate of profit earning by the company. Second, asset turnover, the rate of assets converted in a cash. Third, financial leverage, the ratio of using the mixture of debt and equity. Definition. Financial ratio allow the analyst to assess and analyze the strengths and weaknesses of a given company on an absolute basis and by comparison to other companies in its industry or to an industry standard. In next definition, according to Kohler, a ratio is the relation of the amount A to another B expressed as the ratio of A to B, that is A is to B, or as a simple fraction, integer, decimal, fraction of percentage. Ratio analysis is a study of relationship among various financial factors in a business. What is ratio? First, the ratio refers to the numerical relationship between variables. Second, the relationship between two figures can be established on the basis of some logical methods. Next, it is an assessment of one number in relation to the other. For instance, the ratio of two figures 200 and 100 may be expressed in any of the following ways. First, 2:1. Second, 2/1. Third, 2:1. Fourth, 200%. Modes of expression. As ratio is quantitative relationship, it may be expressed in either of the following ways. First, percentage. It is expressed in percentage. For example, net profit ratio is equals to net profit divided by net sales multiplied by 100, say 45%. Second, pure. It is expressed as a quotient, for example, current ratio, which expresses the relationship between current asset and current liabilities, say 2:1. Next, times. It is expressed in a number of times a particular figure is compared to another figure. Stock turnover ratio, which studies relationship between cost of goods sold and average stock, is 5 times. Next, fraction. It is expressed in fraction. For instance, ratio of fixed assets to share capital is 3/4, that is 0.75. Other way of expression. Ratios can be expressed as a rate or time. Example, the ratio of stock turnover is, say, 1 lakh divided by 50,000 is equals to 2 times. It means stock has been turned over 2 times. Objectives of ratio analysis in a concern. For purpose of analysis, accounting ratios are indispensable. A meaningful analysis of the financial situation and performance is the first great advantage of accounting ratios. This requires ratios and their comparison, which may be first within the same firm over a period of years, second the comparison of one firm with the another. Third point, one firm against the industry as a whole or against predetermined standards, or for one division or department of a firm against other divisions or departments of the same firm. Inter-firm comparison and intra-firm comparison are thus possible on the basis of accounting ratios. This can also be attempted in other ways, but accounting ratios are indispensable in this respect. For example, to judge which firm has the best overall efficiency, one should compare the rate of profit on capital employed for the firms concerned. The size of the profit as such is not relevant. Steps in the ratio analysis. First step. Relevant data is to be selected from the financial statements depending upon the objectives of the concern. Second step. Calculation of appropriate ratios from the above data given in step first. Step third. Comparison of the calculated ratios with the ratios of the same firm in the past, or the ratios developed from projected financial statements, or the ratios of some other firms. Fourth step, interpretation of the calculated ratios. Importance of ratio analysis. Ratio analysis is an aid to measure journal efficiency. Ratio analysis is an aid in comparison of financial data. Ratio analysis helps in planning and forecasting various issues. Ratio analysis is an aid in intra-firm comparison. Ratio analysis helps in facilitating decision making. Ratio analysis used to test profitability. Ratio analysis to test solvency position. Ratio analysis is an effective tool for management. Ratio interpretation. Interpretation of the ratio is an important factor as it requires skill, intelligence, and foresightedness. The impact of various factors like price level changes, change in accounting policies, window dressing, etc., should keep in mind while interpreting the financial statement through this tool, that is, ratio analysis. A single ratio in itself does not convey much of the sense. To make ratios useful, they have to be further interpreted. The interpretation can be done in the various ways. Few of them are as follows. First, single absolute ratio. When single is considered in isolation, one cannot draw an meaningful conclusion, but single ratios may be studied in relation to certain rules of thumb, which are based upon well-proven conventions. Second, number of ratios. Ratio can be interpreted by calculating number of related ratios, because when a single ratio supported by other related additional ratios become more understandable and meaningful. Comparison. The simple and best method of evaluating the performance of the firm is to compare its present ratio with the past ratio, as it gives an indication of the direction of change and reflects whether the firm's performance and financial position has improved, deteriorated, or remained constant over a period of time. Next, projected ratios. Ratios can be calculated for future standards based upon the projected or pro forma financial statements. These future ratios may be taken as standard for comparison, and the ratios calculated on actual financial statement can be compared with the standard ratios to find out variances, if such variable helps in interpretation. Next, inter-firm comparisons. Ratio of one firm can be compared with the ratios of another firm at the same point of time. This type of comparison helps in evaluating relative financial position of the firm. It is considered as inter-firm comparison. Now we'll study about guiding principles of using ratios. The calculation of ratios may not be a difficult task, but their use is not easy. The information on which they are based is important, which influence the use of ratios. Following guiding principles need to be followed while interpreting different ratios. First, data available in financial statements. The ratios are calculated from the data available in financial statements. The reliability of ratios is linked to the accuracy of information in these statements. Before calculating ratios, one must see whether proper concepts and conventions have been used for preparing financial statements or not. Second, objective of analysis. The type of ratios is to be calculated will depend upon the purpose for which these are required. The purpose of user is also important for the analysis of the ratio. Different objectives may require the study of different types of ratios. Choice of ratios. The proper choice of appropriate ratios is also one of the important factors. The ratio should match the purpose for which these are required, and only those ratios should be selected which can throw proper light on the matter to be discussed. Then only relevant conclusion can become. Next, following standards. The ratios will give an indication of financial statements only when discussed with reference to certain standards. These standards can be considered as rule of thumb. The comparison of calculated ratios with the standards will help the analyst in forming his opinion about financial health of the concern. Caliber of the analyst. The ratios are only the tools of analysis, and their interpretation will depend upon the caliber and competency of the analyst. He should be familiar with various financial statements, as wrong interpretation may create havoc for the concern, since wrong conclusions may lead to wrong decisions. Thank you. Guiding principles for use of ratios. The calculation of ratios may not be a difficult task, but their use is not easy. The information on which they are based is important, which influence the use of ratios. Following guiding principles need to be followed while interpreting different ratios. First, data available in financial statements. The ratios are calculated from the data available in financial statements. The reliability of ratios is linked to the accuracy of information in these statements. Before calculating ratios, one should see whether proper concepts and conventions have been used for preparing financial statements or not. Second, objective of analysis. The type of ratio is to be calculated will depend upon the purpose for which these are required. The purpose of user is also important for the analysis of the ratio. Different objectives may require the study of different types of ratios. Next point, choice of ratios. The proper choice of appropriate ratio is also one of the important factors. The ratio should match the purpose for which these are required, and only those ratios should be selected which can throw proper light on the matter to be discussed. Then only relevant conclusion can be come. Next point, following standards. The ratios will give an indication of financial statements only when discussed with reference to certain standards. These standards can be considered as rule of thumb. The comparison of calculated ratios with the standards will help the analyst in forming his opinion about financial health of the concern. Next, caliber of the analyst. The ratios are only the tools of analysis, and their interpretation will depend upon the caliber and competency of the analyst. He should be familiar with various financial statements, as wrong interpretation may create havoc for the concern, since wrong conclusion may lead to wrong decisions. Significance of ratio analysis. Financial ratio analysis is a useful tool for detecting the company's strength and weaknesses, for management, decision making, forecasting and planning, communication, coordination and control. For shareholders, an investor in the company will like to assess the financial position of the concern where he is going to invest. Their first interest will be the security of their investment, and then return in the form of dividend. Dividend is that part of profit which is distributed among the shareholders. For the first purpose, they will try to assess the value of fixed assets and the status of loans. The investors will feel satisfied only if the concern has sufficient amount of assets. Ratio analysis will be useful to the investors in making up his mind whether present financial position of the concern warrants future investment or not. For suppliers, any business firm not only deals in cash, but they have to purchase and sell goods on credit as well. The suppliers extend short-term credit to the concern, so they are interested to know whether financial position of the concern warrants their payments at specified time or not. The concern pays short-term creditors out of its current assets. For employees, employees are considered to be the basic asset of any firm. Their wages and salary increases and amounts of fringe benefits are related to the volume of profits. They are also interested in the financial position of the concern. For government, government is interested to know the overall strength of a concern. Profitability index can also be prepared with the help of ratios. Government may base its future policies on the basis of industrial information available from various units. For income tax authorities, under the Income Tax Act 1961, every assessee engaged in any business and having turnover or gross receipts exceeding rupees 40 lakhs requires that the following ratio should be given. First, gross profit. Second, net profit. Third, stock in trade. Next, material consumed. Multi-purpose ratio. Parties interested: management. Management is interested to know operating ratio, return on capital employed, stock turnover ratio, debtors turnover ratio, solvency ratio, as it explains the profitability of the firm. Creditors, money lenders, and investors make use of current ratios, solvency ratio, creditor turnover ratio, fixed asset ratio, debt service ratio, as this explains liquidity or solvency of the firm. Shareholders, creditors, employees, government make use of return on shareholder fund ratio, capital gearing ratio, dividend cover ratio, yield ratio, proprietary ratio, dividend rate ratio, asset cover of shares, as these ratios helps to know capital structure of the firm. Benchmarks for the ratios. As ratios are relationships or comparisons, a student must know the standard or the benchmark against which company may evaluate the financial performance of the company. A ratio analysis is meaningless if no prior standards set before using this tool. First, competitors' ratio. Every company must have the ratios of its competitors. This helps the company to evaluate its competitive edge in the market. Second, industry ratio. The industry to which the company belongs has its own standards regarding the different inputs and outputs. Hence, the industry ratios help the company to evaluate its industry competitiveness. Next, past ratios. The past ratios of the company help to compare its performance over a period of time and judge whether it has improved or not. Next, forecasted ratios. Many a time, the company sets future plans for itself, whether it forecasts its growth and profits. Similarly, if the ratios are forecasted for the future, the company can understand whether the company stands and how much improvement is required. Limitations of ratio analysis. The ratio analysis is one of the most powerful tools of financial management. The ratio analysis is very fashionable these days and is useful, but one should be aware of its limitations also. Even when the ratios are worked out correctly, it should be remembered that they can at best be used as a doctor uses symptoms, indications that something is wrong somewhere. Just as the doctor will try to get to the real reason, in the same manner, the analyst should try to locate the real factor leading to the present state of affairs. A single ratio in itself is not important or has limited value because trend is more significant in the analysis. Second, a simple ratio would not be able to convey everything. Next, lack of proper standards. Next, difference in definitions. Next, effect of personal opinion. Absolute figures distortive. Ratios may make the comparative study complicated and misleading an account of changes in price level. Ratios become meaningless if detached from the details from which they are derived. Next, ratios are compared on the basis of past experience, and past are not an indicator of future. Quick revision. Financial ratios are usually expressed as a percentage. Financial ratios are simple to calculate, easy to use, and provide a wealth of information that cannot be gotten anywhere else. A single ratio in itself does not convey much of the sense, so it is advisable to use group of ratios for proper conclusion. Accounting ratios not only indicate the present position but also helps in forecasting and planning. The ratios are calculated from the data available in financial statements. The insights gained from analyzing a firm's financial ratios are valuable in forecasts of the firm's future prospects. This module presents the most important key tool of financial analysis, that is ratio analysis. This tool allows the analyst to examine a firm's performance and its financial condition, give its strategy and goals. Ratios are calculated on the basis of accounting information, and the objectives of ratio analysis are to be judge the earning capacity, financial soundness, and operating efficiency of an enterprise. Ratio analysis is useful in analysis of financial statements and also for intra-firm and inter-firm comparison. Accounting ratios provide a quantitative relationship which the analyst may use to make a qualitative judgment about various aspects of financial position and performance of an enterprise. Thank you.